Gold has roared up 32% this year. It's up more than the US tech index, the Nasdaq, and more upside is ahead for gold. This is the weekly. I'm Jessica Amir, a market strategist with Moomoo. Well, the price of gold continues to scale to new record all-time highs, and it's for a gamut of reasons that are all coming together to suggest more gains are ahead for gold. But this week, gold moved up because debt concerns rose. Global debt is now $300 trillion US dollars. That's 3.3 times greater than the world is making in income, known as GDP. So concerns are now getting louder also that whoever wins the US election in about 2 weeks, whether it's Trump or Harris, will cause US debt to explode. Now, this is a key reason why global central banks keep buying record amounts of gold each month. But there are many other factors coming together to support the case for gold. We do know that simply gold traditionally rallies or sees more buying when war tension is rising. Indeed, that's happening. Also consider that gold traditionally does outperform when we start to see the US central bank cutting interest rates, and we've just seen that start to manifest. In fact, if we think about the last 3 times the Federal Reserve has cut interest rates, we've seen gold rally up to new record all-time highs. This chart demonstrates that. Gold has actually rallied about 99% on average the last 3 times the Fed has cut interest rates. That's pretty outstanding. Also consider that when the US central bank does cut interest rates, that provokes other global banks to buy more gold. So it becomes a vicious cycle. That's something for you to think about. All in all, just consider this. Expect more highs for gold, particularly if history repeats itself. Gold could keep hitting new all-time highs for the next several years for those gamut of factors. This week, billionaire investor Paul Tudor Jones said that he's buying gold and reckons that young investors should be holding more gold too in their portfolios in some way, shape or form. He's worried about global debt levels rising, and so too is International Monetary Fund, who says there's greater pressure on financial stability, perhaps more than ever before, and this chart demonstrates that. The other thing to consider is that gold has produced better returns than the Australian share market over the longer term, and gold also tends to do well when markets are falling. So what stocks should you be looking at? What looks compelling? Or maybe what ETFs look compelling? Let's take a look at those now. Why don't we start with scale? Who is the biggest gold company that you need to consider? This chart demonstrates that we've got 3 of the world's biggest top producers producing returns in the order of 13 to 60%. The world's biggest gold producer, Newmont. We've got the world's second biggest, Agnico, and the third biggest, Barrick Gold. What's really interesting to note is that Agnico, their shares are up 60% this year, while Newmont, at the top left, they're the world's biggest. Their shares are up 19% this year, but they were up by more. But do consider that they fell 15% on Thursday. Why was that? Because we've spoken about the gold price being at record all-time highs. Well, Newmont did deliver some good news, but there was also bad news in their results. Newmont sales rose about 90%, but the miners' costs rose. That's because they're paying higher wages and they're also paying higher fuel prices as well. So that's why their profits didn't rise as much as the lofty expectations. But I do think that investors will probably be buying the dip into Newmont. Also consider the world's biggest holder of gold is bottom right. That's the SPDR Gold Shares ETF. That ETF is up 13%. Now let's look on the left-hand side of the page. We can see the Gold Miners ETF is up by 40%. This is a great way to get access to gold. If you don't want to be a stock picker, you can simply buy the ETF and that'll get you exposure to growth in the gold companies. Let's have a look at what Moomoo investors have been buying. This week, we've seen plenty of buying in Tesla, Nvidia, and Trump Media. As you reported on our daily report on Friday, Tesla shares rose 22% on the day that they reported earnings. That was the day after they reported earnings, in fact. Now, this jump, that 22% lift, its biggest gain in 10 years in a day, and that basically spurred on a rally in other mega cap tech stocks, some of which report next week. Now, if Tesla's results and bullish outlook is something to go by, then you probably might be expecting rosy report cards and share price rallies in Google, Apple, Meta, and Microsoft when they report results next week. Now, these are some of the most influential companies in the world and the stock market. Simply, that means when their shares rally, the share market might rally. But if they deliver sour grapes and disappointing results, then things could get ugly. The market could pull back, especially because we do have margin loans on share trading accounts at record all-time highs. So this is a concern. But if the market does pull back, you'll probably see investors buy the dip. Now, this is traditionally what investment managers do when stocks pull back. It means they can buy more of quality stocks that they like at cheaper prices. Now, consider that we've got a record amount of cash and money market funds on the sidelines ready to put money into work and buy the dip if we see markets pull back. There's an outstanding $6.5 trillion of money on the sidelines. And that's the weekly.